Credit card interest is not simply added once at the end of the year. On many accounts, it is calculated using daily balances, which means the cost can grow every day that an interest-bearing balance remains unpaid. Understanding that process helps explain why a high annual percentage rate can make debt difficult to eliminate. The annual percentage rate, or APR, is the annualized price of borrowing money. A card may have different APRs for purchases, balance transfers, cash advances, and penalty situations. Some rates are fixed, while many are variable and can change when an underlying index, such as the prime rate, changes. The card's pricing table and agreement explain which rate applies to each type of balance. To convert an APR into a daily periodic rate, an issuer commonly divides the APR by 365. For example, a 24% APR divided by 365 is approximately 0.0658% per day. That daily percentage may look small, but it is applied repeatedly to an interest-bearing balance. Many issuers use an average daily balance method. The issuer tracks the balance for each day of the billing cycle, accounting for purchases, payments, credits, and sometimes previously accrued interest. It then calculates an average or applies the daily periodic rate to the daily balances. The exact formula depends on the agreement, which is why two cards with the same APR can produce slightly different charges when payment timing differs. Consider a simplified example. Suppose you carry a $2,000 purchase balance at a 24% APR and make no new purchases. A rough monthly estimate is $2,000 multiplied by 2%, or about $40. The real charge may be different because the issuer generally calculates interest daily, and the billing cycle may have 28, 30, or 31 days. If you pay $300 halfway through the cycle instead of waiting until the due date, the lower balance may reduce the interest charged for the remaining days. A grace period can prevent purchase interest when its conditions are met. Most cards offer a grace period on purchases, but issuers are not required to do so. When a grace period applies, paying the full statement balance by the due date generally allows qualifying purchases to avoid interest. If you carry a balance from one month to the next, new purchases may begin accruing interest from the transaction date until the grace period is restored under the issuer's rules. Cash advances are different. They commonly begin accruing interest immediately, often at a separate APR, and may include a transaction fee. Balance transfers can also carry a separate rate and fee. A promotional 0% APR may temporarily prevent interest on a specific balance, but the transfer fee can still create an immediate cost, and the standard APR generally applies after the promotion ends. Residual interest, sometimes called trailing interest, can surprise people who believe they paid a card off. Imagine that interest accumulated between the statement closing date and the date the issuer received your full payment. That interest may not appear until the next statement because it had not yet been calculated when the previous statement closed. Checking the following statement is important before assuming the account has a permanent zero balance. The order in which payments are applied also matters. Federal rules generally require amounts paid above the minimum to be directed first to balances with the highest APR, with special rules for deferred interest balances near the end of a promotion. The minimum portion can be allocated differently under the card agreement. This is one reason carrying several balance types on one card can become confusing. A common misconception is that a lower minimum payment makes a balance affordable. The minimum may cover interest, fees, and only a small part of principal. Principal is the amount actually borrowed. When principal falls slowly, future interest continues to be calculated on a large balance. The most practical ways to reduce interest are straightforward. Avoid carrying balances when possible. Pay the full statement balance during the grace period. When debt already exists, stop adding non-essential charges and pay earlier and more frequently if the issuer calculates interest daily. Direct extra money toward the highest APR balance while maintaining minimum payments on every account. Review promotional expiration dates before the standard rate begins. Also compare APRs only after reviewing fees and terms. A 0% offer with a large transfer fee may or may not be cheaper than a low-rate loan. A rewards card with a high APR can be valuable for someone who pays in full, but expensive for someone who revolves debt. The main takeaway is that APR is an annual label, but credit card interest is often a daily cost. The balance, rate, payment date, transaction type, grace period, and fees all influence what you ultimately pay. This video is for informational and educational purposes only and is not financial, legal, or investment advice. Review your card agreement and consider your individual financial circumstances before making decisions.